What's the difference between a Social Security penalty and a Social Security tax? And how do you avoid them both? That's what we'll be talking about in today's video. There are two different ways you can lose a portion of your Social Security. The first way is through a penalty, and the second way is through a tax. These two different losses in Social Security income come about in totally different ways and in violation of totally different thresholds. Once you understand the drivers behind each, you'll be in a better position to avoid them both. First, let's talk about the Social Security penalty. This is the penalty you incur if you begin drawing Social Security prior to your full retirement age, while also earning more than the minimum allowable threshold put forth by the IRS. By the way, full retirement age is 66 and 4 months if you were born in 1956, 66 and 6 months for people born in 1957, and gradually increasing to 67 for people born in 1960 and later. Now let's talk about the minimum allowable income thresholds. In 2023, if you collect benefits before full retirement age and continue to work, the Social Security Administration will temporarily withhold $1 in benefits for every $2 you earn over $21,240. If you will reach full retirement age in 2023, the earning limit goes up to $56,520, and $1 is deducted from your benefits for every $3 you earn over that. Once you actually attain full retirement age, the earning limit goes away. By the way, what does the IRS count as earnings? They only count the wages you make from your job or your net earnings if you're self-employed. These include bonuses, commissions, and vacation pay. However, they don't count pensions, annuities, investment income, interest, veterans, or other government or military retirement benefits. So here's an example of how the Social Security penalty works. Let's say we're in 2023 and you don't reach full retirement age until 2024. Let's also say that your net earnings this year are $50,000. We'll also say that you've begun drawing Social Security in the amount of $30,000 per year. Well, the first thing we have to do is figure out the extent to which you exceeded the $21,240 income threshold. So we subtract $21,240 from $50,000. That gives us $28,760. So you've exceeded the Social Security income threshold by $28,760. We would then divide that by 2 to determine your Social Security penalty. $28,760 divided by 2 equals $14,380. So your penalty that year for working while also receiving Social Security is a whopping $14,380. Keep in mind, however, that if you do have benefits withheld before reaching full retirement age due to work income, you can recoup them later on. When you hit that full retirement age, your monthly Social Security benefit gets bumped up over time to make up for that earlier withholding. All right, now let's tackle Social Security taxation. For starters, we have to identify a term known as provisional income. That's the income the IRS tracks to determine if they're going to tax your Social Security. What counts as provisional income? Well, any 1099s from taxable investments count as provisional income. Maybe you sold a stock and had a capital gain, or maybe you received dividends or interest from a stock or bond. If that took place outside of a traditional retirement account like an IRA or a 401k, then it counts as provisional income. Next, any distributions at all from your tax-deferred retirement accounts count as provisional income. You take a distribution from your IRA, 401k, 403b, SEP, simple, you get the idea. That's also going to count as provisional income. Furthermore, if you're planning on receiving a pension in retirement, then that too will count as provisional income. Hey, maybe you're planning on working in retirement. Guess what? That also counts as provisional income. Now, this next one may surprise you. Even though municipal bond interest is free from federal tax, it too counts as provisional income. Finally, and this one is really going to chap your hide, 1/2 of your Social Security counts as provisional income. You heard that right. 1/2 of your Social Security counts as provisional income. So the IRS adds all this provisional income up, and if as a single person it adds up to more than $25,000, or if as a married couple it adds up to more than $32,000, then up to 50% of your Social Security can become taxable to you at your highest marginal tax bracket. I know what you're thinking. This sounds like a really raw deal, right? Well, it gets worse. If as a single person your provisional income adds up to more than $34,000, or if as a married couple it adds up to more than $44,000, then guess what? Up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. You heard that right. So here's an example to show you how this all might work. Let's say that you and your spouse are planning on getting $40,000 of Social Security. Let's also say that you take $75,000 out of your IRA to meet your lifestyle needs in retirement. Let's figure out your provisional income amount in this scenario. We take half of your Social Security, that's $20,000, and we add it to your $75,000 IRA distribution. That's a total of $95,000 of provisional income, which far exceeds the point where up to 85% of your Social Security could become taxable. Keep in mind that the standard deduction does not count against your provisional income levels. So if your provisional income adds up to $95,000, then that's the number the IRS uses. So, because you have $95,000 of provisional income, the IRS will now take 85% of your Social Security and pile it right on top of all your other income. For the purposes of this example, let's say you're in the 22% federal marginal tax bracket. So here's how we figure your Social Security tax. We multiply your Social Security amount, $40,000, by 85%. That gives us $34,000. We then multiply that $34,000 by your marginal tax rate of 22%. That gives us $7,480. In other words, because you took so much money out of your IRA, you now have a $7,480 tax on your Social Security. So today we've talked about two different ways that you can lose portions of your Social Security. It's easy to confuse the two, even though they come about through the violation of two entirely different thresholds. You pay a Social Security penalty if you exceed the Social Security minimum income threshold prior to your full retirement age. Conversely, you pay a tax on your Social Security if you exceed provisional income thresholds, regardless of your age. Even if you reach full retirement age, you can continue to pay tax on your Social Security in perpetuity if you don't keep your provisional income in check. If you want to learn more about how to shield your Social Security from taxes and penalties, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. By the way, if you have any comments or questions, feel free to drop them into the comments section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.